So in previous videos, we've actually discussed the REIT industry in its entirety and how much opportunity it actually can present for a value investor. In this video, we will look at a specific company that, in my opinion, can have really good potential for the growth in the future. So let's get into it. The company that we are going to talk about today is Park Hotels and Resorts. It is one of the largest publicly traded lodging real estate investment trusts. Their portfolio consists of 60 premium branded hotels and resorts with over 33,000 rooms located in prime US markets with high barriers to entry. Nearly 80% of all of their portfolio is located in the central business district of major cities, resorts, or conference destinations. They affiliate with leading brands such as Hilton, Marriott, and Hyatt. Yet the company was not built from the ground up. It was actually part of Hilton brand. In 2015, Hilton CEO Christopher Nazzetta stated that the company was evaluating a corporate spin-off of a REIT to hold its $13 billion real estate portfolio. The plan was a part of Nazzetta's strategy of moving Hilton to an asset-light business model. This would basically enable them to expand a lot faster in the international markets. The spin-off was completed in 2017, and ever since then the company has been operating as an independent, publicly traded company. In 2018, they sold 13 hotels that consisted of its non-core assets, including 10 of its international properties, for a total of $519 million. In 2019, Park acquired Chesapeake Lodging Trust for around $1 billion in cash plus around $1 billion in stock. The purchase added 18 hotels to the Park portfolios and diversified it by adding hotels from brands such as Marriott, Hyatt, among others. So how does this REIT industry actually work? If you've watched the last video, you probably know already how exactly this company operates, but if you don't know, it's very simple. The REIT business model consists of leasing spaces and collecting rents on properties, then distributing that income as dividend to the shareholders. In the case of Park, their hotels are generally managed by a qualified third-party management company. They currently operate only 4 hotels and also 3 laundry facilities. The management contract is basically when an owner of a real estate gives the right to the company, with or without a brand, the ability to run business for some fees. Only 5,000 out of 33,000 rooms are rented to the hotel chain that's not Hilton. That's basically around 14%. 25,500 rooms are actually free sample. That means that they are fully owned by the company. That's about 77% of all the rooms. The rest is basically ground leases. As mentioned before, they also have a laundry business that helps operate their hotels, yet that business actually makes pretty much no profits whatsoever. Ultimately, their financial positions will always depend on the ability of the tenants to pay that rent. For the growth of the company, they're always going to rely on financing. And discussed in the previous video, REITs rely on financing because they have to pay 90% of all taxable income to their shareholders, meaning that they basically have no capital to actually reinvest into the business. For this reason, the actual financing of the business is going to be an essential part of it, and if the company finds itself in a bad situation financially, the loans that they will take are going to have really bad terms on them, and that will jeopardize the whole business operation. So financing is an essential part of the business, and we will get into that a little bit later on. When it comes to their competitive advantage, the really only competitive advantage they have is the quality of their assets and the actual size. The quality is pretty self-explanatory. If you have a really high-end real estate, that real estate is most likely will never really depreciate too much. When it comes to the size, the bigger the size of the actual REIT, the more easily they can attract bigger clients with, bigger chains of hotels. They really don't really have any specific moat, which is something to worry about, but not too much, because REITs are basically like a hedge funds, and we will see this throughout all of this analysis because they operate very similarly to them. So they don't really have any, but once again, that's neither do any other competition has any really moat to go off of. Now let's look at the management, and this is a very important part because, well, once again, since the REITs operate as basically investment funds, they need to have good management in order to manage that real estate. The Glassdoor rating is actually not relevant for this analysis, since they only have 3 reviews, so we will ignore that because the results are going to be very extreme, either for the good or for the bad. So let's ignore that part. The compensation for the executives is determined by an outside company. It is divided into 3 parts and most of it is actually at risk. So those 3 parts are base salary, short-term and long-term compensations. Base salary is based on position of an actual individual and the individual contributions to the company. Self-explanatory. Short-term rewards are based on both personal performance as well as short-term performance of the company. When it comes to the performance, the key metrics here are RevPAR and debt to earnings. Long-term compensation seems to be divided into 2 parts. Half of it is how much time the actual executive stayed with the company, and the second part is the shareholder returns on the investment with the company. Now that second one sounds a little bit sketchy, right? We're taught that if compensation is based on the actual market returns, then it's not really a good thing. It's probably going to benefit way more luck than the actual performance of those executives. Well, not exactly. We need to remember that REITs operate very similarly to the financial funds. In financial funds, in mutual funds, and hedge funds, your performance is going to depend on the returns that you can get for the investor. Same happens with the REITs. Is it a good metric to go off of? Not exactly, since once again, markets are very unpredictable and luck can play a big part in that. Yet it also makes a lot of sense since, once again, we are talking about a fund that manages real estate. So it makes kind of sense. Not the best one, but it makes sense. For the year of 2019, the compensation for the CEO was around $7 million. Considering the median employee pay of $28,000, the pay gap is 243 to 1. Now, if you look at other companies, this is actually not something very abnormal. If you look at the compensation for Siemens Group CEO David Siemens, the pay is lower, but not by that much. So there are really no major flags when it comes to the CEO compensation, in my opinion. Other companies pay similar fees to actually keep their employees in, and once again, so far they have done pretty good job when it comes to managing the company, so no complaints there. Now let's actually look at the industry and do some direct comparisons in order to understand where this company stands among their peers. So first of all, we have the completely direct competition. This means that the companies that we are comparing them are all REITs, they all operate in the lodging industries, as well as they have the same market cap. So let's start with some of these metrics. First one is the revenue growth per year for the past 5 years. When it comes to the revenues, we can see that Park is lagging behind many of its competition. We need to also remember that they have been going through kind of restructuring. They've been selling international hotels and they've been trying to purchase other hotels to replace those inside US. So I will give them a little bit of a discount when it comes to the actual revenue growth. Now let's look at actual comparison between the second quarter of 2020 and 2019 for both revenues and profits. What this does is basically see how much damage the coronavirus has actually done to these businesses and see which ones have actually suffered less or more depending on the situation. When it comes to the revenues, the Park is basically about the average, but when it comes to the profits, it actually took a far larger hit than any other companies in this comparison and way more than the actual average. So we can see that this company has been hit really hard by this virus, and this is one of the reasons why it is so appealing, as we'll see in a little bit. So when it comes to the margins, we can see that the actual margins is far larger than for the most companies. This is not actually all the truth because as we will see later on, in 2017 they have a huge spike in profits, and this is why the average is actually so biased towards that really huge value. So if we exclude that 2017 number, the actual margins will be much more close to the actual average of the business. Debt to equity is actually great for this company. We can see that some of the companies, such as the Raymond holding, is really over-leveraged, if you will. One of the goals of the company is always to deleverage as much as they can, and as we can see, they have done a pretty decent job with it. Not the best one, because they have taken a lot of debt in the last couple of months, but not the worst one either. Now, when it comes to the price to book value, this is the most interesting part, because we can see that the company has actually taken huge hit, not only when it comes to the revenues and profits, but also when it comes to the price that we need to pay for those assets. And this is where the opportunity really comes in, but we'll get to that in a second. Now, I also created a second list, which is basically the list of all the same companies, but now we added a few other companies that operate into different rate sectors. So we have specialty, industry, and rates. Once again, this sample size is very small, so it's really not indicative of anything that's going on in the industry, but we can see that some of the companies, especially in the industry sector, have actually risen and have actually increased their earnings and revenues. So once again, just to show you that not all the rate sectors have actually suffered those major losses. It's very difficult to make any projections for this industry, because once again, the situation is so uncertain that tomorrow we can have an incredible increase with more hotels opening, or we can do the other thing around, which is we can have even more losses if the hotels decide to close down due to some unknown factors that are going to happen in the future. One thing that I do want to remind us is that most sectors that have taken huge beatings are almost always the sectors that actually have the best returns over the next few years. This doesn't happen necessarily because they can recover very fast, but simply because the price that you have to pay for them is so ridiculously low. So now that we looked at the industry, let's actually dive into the specifics of the financials of this company. So first of all, we have the revenues. Revenues, as we've seen before, have been extremely stable for this company, not really moving that far away. During this year, the first half earnings were reduced by more than 50%. It is still very uncertain if that can grow or not. Since the business has a cyclical nature to it and we are going into the off-season, the most likely thing is that the reduction will not diminish. So when it comes to the actual profits, apart from 2017, the actual profits were quite stable. In 2020, however, the things aren't as smooth. The actual losses in 2020 were $937 million, while in 2019 there was a profit of $193,000. Now, yet things aren't as bad as they actually look. If we go into detail, we can see that out of all of that loss, $694 million of it was the impairment of the goodwill, meaning those are basically non-cash charges. A lot of the companies actually started doing this simply because they have net losses. They can basically add more losses to it, and it wouldn't actually make things so much worse than they already are, and so they take advantage of it to actually clean up their balance sheets. Now, is it a good thing that they're doing this? I'm not really sure. I think that most of these hotels have exaggerated prices, so since they are doing it, it might actually be a good thing. For the actual return on equity and return on assets, we can see that in 2017 that value was really high due to those incredible gains. So if we exclude that value, the actual average is around 6.5%. The industry average for rates is around 5%. So once again, Park is actually above the average in this category, meaning that somehow they can actually manage pretty well the cash. When it comes to net margins, if we once again exclude that 2017 value, the net margins are around 8 to 9%. Overall, this is a great value, yet if we look at other rates that operate in the different sectors, we can see that some of them have actually a really big net margins. So comparing it to other sectors, not so good. Comparing it to normal sector, quite good. When it comes to the financial position, they have actually quite a bit of debt. They did contract more this year as well in order to have more liquidity. They made an almost $700 million loan at a 7.5%. Not a very good deal. This gave them a liquidity of $1.3 billion. The debt obligations for the 2021 revolver were extended to 2023, giving them more time to actually pay those loans. In the end of 2023, they will have to pay around $2 billion of loans. They also want to issue more senior notes in amount of $650 million so they can pay back that 2016 revolver credit. So basically they can extend even more debt from that 2021 deadline further on. This is a good move, and yet it will likely prove to be quite expensive in the short term because that senior note will most likely be at around 7% as well, since they do have a lot of debts and their financial situation currently isn't looking as great as it once did. Now, they are always talking about deleveraging their portfolio, and they have been doing it quite aggressively over the last few years. Once again, this situation is completely different, and they actually want to have a lot more liquidity that they actually need in order to sustain any future unpredicted damages that may occur. Now, considering the awful results and very questionable recovery, it's most likely that in the next 4 quarters they will keep on losing cash. In the worst case scenario, they will burn cash at around $100 to $100 million per quarter. This means that they would lose around 400 to 600 million in the next 4 quarters, leaving them with less than 900 million in 2021. At that point, they are expected to make profit again, and yet in order to pay off of the debts that they will have by that point, it is likely that they're going to take one more loan or maybe even several. At the rating of B, they're going to pay a high price for it, yet some people are questioning if they can actually make it out of it. I'm a little bit more bullish on it, and I think they can make it easily out of it. The question here really is how much greater they will come out of this crisis than the other competition. And this is where it's really interesting and really unpredictable, but it's very interesting due to the actual price that we can pay for it, and that's exactly what we'll look next. Now let's actually start by considering the old NAV value of the company. NAV value is basically net asset value of the company, more known and more used by someone like Benjamin Graham, for example. The total equity of the company is around $5.3 billion, and the market cap of the company is at around 2.5. This means that they have basically the price to book value of around 0.5, giving them a margin of safety of around 50%. And this is why they're so interesting. Other companies may have similar offerings, but they are not so cheap as them. Yes, they did suffer major losses, and they suffer more than some of the competition, and yet I think that at that price, it's actually very justifiable to purchase this company. Now, if you look at something more modern, such as discount cash flow model, we can see that at an average growth of cash flow of around 2%, perpetual growth of around 1%, and a 10% discount rate, a very conservative numbers for the next 10 years, the true value of the company is at around $15 per share. At around $10 at this current time, this can offer us an average return of around 15 to 14%. So in conclusion, we can see that this company has taken a huge hit during this coronavirus. These things aren't going to get to normal that fast. The management is solid but not exceptional, and probably the price is the biggest attraction point for this company. So I wouldn't recommend to make this a primary holding or a holding that has a lot of value in your portfolio, because it's going to really be a little bit of a risky one, especially due to that uncertainty moving forward. For that risk, of course, the price is really good, but once again, we really don't know how this company can turn out to be, whether it's going to grow really well in 2021 or if it's actually going to go down, and the actual excessive debt that they have been contracting at really high interest rates, it can actually, beat it down to a point where it's actually not going to grow that much into the value. Nevertheless, this is a very interesting offering, and paired with some other undervalued companies, this can make a really interesting basket in your portfolio that can, once again, provide you a lot of value if things work out well. And if things don't work out well, it's not really ever going to lose that much more money to you, because the company is so undervalued at this point in time. I hope you enjoyed this video. Let me know what you think about the Park Hotels. Do you think this is a buy or a sell? And let me know what other companies in this sector or in other sectors you're currently looking at. I will be really interesting to actually look at other offerings and other companies. And until the next one, see you later. Bye bye.